Let's get this recorded here. Recording, test. Okay. So, today we're going to talk about IFVGs, why we prefer them to regular FVGs, and how they actually work within our auction theory model. Why IFVGs are different than fair value gaps. But before we get into defining either one, let's make something really clear. Fair value gaps and inversion fair value gaps, they're just fancy names. Okay, I know they're super popular with ICT. I call them FVGs just because everyone knows that by that name. But they're just a fancy name for auction theory price action. Okay, something that's been along for over 100 years. Okay, ICT didn't invent fair value gaps. He didn't invent these concepts. They're just reworded, renamed. So neither one means anything by itself. What we actually care about is what happened in the auction that caused those specific structures to exist. And these gaps are ultimately evidence that price has moved aggressively through an area and didn't conduct much two-way trade there. So they essentially give us another piece of information. An area that's created by aggression from one side failed to continue functioning for that side, and then the auction began operating on the other side of it. That's why we generally prefer IFVGs over FVGs. And don't worry, I'll get into examples and more detail on that. But essentially, we prefer inversion fair value gaps because they require the market to prove more to us. Instead of saying, hey, here's an imbalance, I think it's going to hold. Oop. We're actually moving towards, here's an imbalance, it failed, price got through it, the original side could not reclaim it, and now we're seeing evidence of acceptance on the other side. So a lot more information, a lot more confirmation with IFVGs versus regular FVGs. Okay, so we're also going to translate everything back into auction language. Who is aggressive? Did that aggression hold? Did it fail? Who is controlling the auction now? Where is price being accepted? Because at the end of the day, FVGs, gaps, blah, 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 they're just fancy names that were given to observable auction behavior. Okay, so let's start with a regular fair value gap, okay? So a regular fair value gap is a 3-candle imbalance, all right? So in a bearish fair value gap, we have an area between the low of candle number 1 and the high of candle number 3. Okay, candle number 1, candle number 2, candle number 3. This is the fair value gap, right? Pretty straightforward. I think everybody pretty much knows what FVGs are. But forget the name FVG for a second. Let's look at what actually happened here, okay? Price moves aggressively through here. Price moves rapidly enough that there's no two-way business conducted here, okay? That's why the gap exists. There's just aggressive selling through this area. Created the gap. There's clearly no two-way auction happening, in these candles. Very strong-bodied bearish candles, right? So when we look at a regular fair value gap, we're looking at evidence of prior directional aggression and imbalance in the auction. And that is useful information, but the problem comes when traders take that information and turn it into a prediction. Okay? You look at this and you say, oh, here's a bearish fair value gap. We're going to return to this and reject it and continue selling. Now, sometimes, yes, that works. But at the moment of that entry, you're basically just making an assumption without a lot of information about what will happen. Okay, the fair value gap tells us that there was aggression here, but there's not a lot of confirmation when you're just trading off a regular fair value gap. And this will make a lot more sense when I get into the inversion fair value gaps, right? It's not magic support, it's not magic resistance, it's not automatically an entry, it's simply evidence about how the auction previously moved through that area. So let's take a look at an example here. Okay, so we'll just use this same area, all right? There's a bunch of lows here, a bunch of sell-side liquidity. We sweep the lows. We get a bearish displacement. Okay, now price is retracing back towards that bearish displacement. And if you place your sell order right here when it retraces back, what are you actually saying? You're saying, okay, bears were aggressive here, so I believe they're going to continue to be aggressive. Notice that last part. You're basically making an assumption. You don't have a whole lot of information other than you created this aggression, you retraced back into it, and now you're assuming price is going to continue lower. But the market has not demonstrated that yet. Okay? Big thing here, we just swept a bunch of sell-side liquidity, and we do have some buyers stepping in. So you're just anticipating the reaction, and this doesn't make trading regular fair value gaps inherently wrong, but there is a trade-off. You're basically receiving less confirmation in exchange for a potentially better entry or a tighter stop, which isn't our goal. So the goal is to start asking what actually has happened since that fair value gap was created, because the market continued to produce information. And sometimes the most valuable information is going to become when the actual fair value gap doesn't hold at all. And this is how we're going to get into why we prefer inversion fair value gaps. Okay? So let's talk about inversion fair value gaps. Right? So an inversion fair value gap basically starts as a regular fair value gap. Another thing I want to note really quickly here, when I have two gaps in a row, I tend to treat them as one large gap. So that's just one of the discretionary parts of my trading, and different people use different things. Some people use the top one, some people use the bottom one. I use everything as a whole. So we have two fair value gaps here. I'm going to treat them as one, okay? So we're just going to treat these two fair value gaps as one because there's two right in a row. Okay, so here's our example. We have our aggressive sell-off. We have our group of regular bearish fair value gaps that were created. Sellers displaced lower. There's obvious signs of aggression on this sweep. And later, coming up here, price returns to the area. So if sellers are still in control here, we would expect this fair value gap right here to hold, right? Meaning you don't want to see buyers close above it. If we're using this as a regular fair value gap, we're expecting price to hold here and sellers to continue downward. But it doesn't, right? Obviously, buyers keep pushing into this fair value gap. Sellers try to regain control in this candle right here. You see the strong wick, but buyers immediately regain control. And instead of sellers successfully reclaiming that area, price begins holding above it. You see this candle right here is the one that closed above the fair value gap, right? So now we've essentially inversed the fair value gap. Our bearish fair value gap here, now it turns into an inverted fair value gap. Price came back above, closed above what was previously a regular fair value gap. Now that's what we call inverted. Okay, because now buyers are in control, so the bearish fair value gap has been inverted right here. Okay, so again, forget the name. What actually happened in the auction here? If you think about actual price delivery for a moment, what happened? We swept all these sell side lows, very aggressive, sellers coming in very aggressively, leaving this gap, right? But price returns to this gap. Instead of holding, buyers now regain control and close above it. This is essentially acting as a failed reclaim right here, okay? Sellers are failing to reclaim this low. Sellers are failing to hold this regular fair value gap. The opposite side buyers step in, and kind of claim the tug of war, as I like to call it, and invert that gap. So the auction essentially began operating above an area where sellers were previously in control. Okay, because price came back into this area, sellers could not hold control or regain it. Buyer is the one that will tug a war game. Okay. The failure is what interests us. The change in behavior is what interests us, right? Acceptance here on the opposite side of what was previously a regular fair value gap, that's what interests us. Okay, so inversion fair value gaps basically take your initial steps of auction theory. You've got sweep, displacement, failed reclaim, and acceptance shift. You see where I'm going with here? Like, this gives you a lot more information and a lot more confirmation about what's actually going on in the market. So, when we're saying inversion for value gaps, we're saying an area of prior directional aggression failed. Okay, prior directional aggression being the seller's aggression, that failed. And now the opposing side, the buyers, gained ground through that. And now we're looking for evidence that the auction is now accepting price on the opposite side. Okay, so inversion fair value gap is basically just a fancy name for, auction theory and price delivery. Trade the information that the auction gives you, right? So this is where the IFVGs become especially useful because, failure of what was once the regular fair value gap, that gives us really valuable information. Okay, the original area failed. The sellers failed to keep control. Do you see how that's a lot more information and a lot more confirmation than just trying to trade regular fair value gaps? Regular fair value gaps, there's not a whole lot of information. Like, you don't know if this is going to hold. And yeah, nothing's 100%. You don't know if this was going to hold either. It could come back and reject through it. But look at how many other steps it takes to confirm that inversion fair value gap versus just waiting on the regular fair value gaps, okay? So again, the IFVGs require a lot more steps of auction theory. Sweep, displacement, failed reclaim, acceptance shift. There's a lot going on here that's confirming what's going on. Okay. So let's take a look at some examples here. Here's another easy one right here. Okay, we have our buy side liquidity. We've got a sweep, right? Buyers are stepping in control. You can see they're leaving behind regular fair value gaps. At this point right here, they're just regular fair value gaps. But after the sweep, we're going to see what happens, right? We got the sweep. There's a couple bullish fair value gaps left behind. Sweep, we're coming back into the bullish fair value gap. Buyers, they try to keep control here, wicking, trying to hold above, but eventually sellers gain control. They close back below the bullish IFVG and take full control, inverting that fair value gap, right? Same thing happens on this lower one right here. Okay, pretty straightforward. Not a whole lot to talk about. Once you start seeing it, it makes a lot more sense. And it will just give you a lot more information than regular fair value gaps. I'm obviously cherry picking, but this is just a very basic video to show you guys an example. We did come back. There's one. So it's basically the opposite side, right? So if you have a liquidity sweep and then you're looking for a potential reversal, let's say you sweep buy side liquidity, you're looking for a potential reversal and you're going to start looking for shorts. Normally, if you're looking for shorts, a regular fair value gap would be bearish, right? But an inverted fair value gap is going to come from the bullish side. Okay, right there. And yes, sometimes price doesn't trade back into all of them, right? So you see after this sweep, we had this left behind. Price did not trade back into this one, but it did trade back into this one, okay? And again, here we've got an even larger one down here. This one is crazy. You guys see how Like, it just requires so much more information. You have a much larger, like, M-shaped sweep here. If you're trading on, like, the higher time frames, you might be saying, okay, I'm going to wait for even more confirmation, change in state of delivery below this one. I'm going to wait for price to invert this one. And you see how for, like, 8 hours straight, it just vacillates inside of here, okay? Buyers are clearly not able to regain control anywhere in here. And that eventually produces this massive sell-off. Okay. I'm gonna see if I can find an example of where regular fair value gap fails along with an inverted one. Yes, I should have figured these examples out first, but I did not. Here's another good example. Buy side liquidity swept. The leg that swept the liquidity, what do we got? We actually got a huge group of bullish fair value gaps left behind. Price closes below them. Buyers have absolutely zero control here. Sellers immediately take control. So you can see how the IFVGs require basically almost all the steps of the auction theory, you know, the first steps of auction theory. You've got liquidity sweep. Obviously, nothing happens without a sweep. You've got displacement. The displacement occurs with the bullish fair value gaps that were left behind. Okay, so that's your displacement. What's the next step? You've got a failed reclaim. So a reclaim, a true reclaim would be like, okay, we're going to come back into these bullish fair value gaps and then continue upward. You know, a lot of people might think that, right? Like, oh, we made a higher high up here. Now price is retracing. It's kind of retracing back into about 50% of this leg. We're going to take the trade on the bullish fair value gap to continue up. Nope. Because what does that give you? It doesn't give you much confirmation, right? You're just kind of basically assuming. Whereas if you're like, hey, I'm going to wait for this fair value gap to be inverted, right? You're waiting for some more steps. The failed reclaim especially, right? Price fails, you know, the buyers fail to reclaim their movement in here. If they were going to continue their trend, if buyers were going to stay in control, they would have, you know, come into this area, you know, wicked, rejected it, and continued up. But they failed. That's, you know, the failed reclaim. Buyers failed the little tug-of-war game. Sellers ended up taking control. There's your failed reclaim when it closes back below. That's kind of what I consider the failed reclaim. An acceptance shift would be, you know, buyers are still trying to step in here, but sellers said, nope, we're going to trade in this new area of value. The market has accepted a new lower area of value, okay? And then value migration towards the opposing target. Okay, let's see, I think that's pretty much it. So essentially, when you're reading the IFVG, again, you're going to be asking a lot of questions because there's a lot more steps. So what did this area originally represent? Did the aggression actually fail, right? Where did the buyer's aggression, you know, in this case, displacement was left by buyer's aggression. Where did that aggression fail? Here, when sellers closed back below the IFVG, right? What happened around the failure? You know, what happened after the failure? We have very clear consolidation here, accepting price at lower value. And, you know, anywhere in here is a great entry. You're asking, when this is happening, could the original side reclaim the area, or did the opposing side reclaim? And that's your failed reclaim. Where is value next? Where is your acceptance shift after the IFVG? And then where is price likely to conduct business next? Okay? So what would invalidate an IFVG? Let's see if I can take some of this crap off here. Think about what would invalidate an IFVG. You know, let's say price closes below it. You've got all your confirmations. You've got everything. And you're like, okay, well, nothing is 100%, right? So you still need a kind of safety net, right? IFVGs, as with anything else, they're not perfect. Sometimes they fail. So a good rule of thumb is, you know, we come down here. Okay, price is accepting this IFVG. If price were to come back up and close back above it, that's when I would say my thesis or my theory is invalid, right? So a safe stop would be, you know, above these little highs right here, or even safer stop would be above these. But that's not arbitrary, right? So for me, I save myself a lot of risk, and this is another reason why I love IFVGs. I save myself a lot of risk because let's say I have my stop up here, right? But price comes back up and closes, you know, somewhere in this area, closes back above the IFVG. I'm like, okay, thesis invalid. I just saved myself like a quarter of my risk, right? Um, so with IFVGs, they're also great because you don't have to arbitrarily keep your stop. If you are able to manage your trade and watch price when price closes back above or below the IFVG, that's when you can take your trade out. So a lot of times it does actually save you quite a bit of risk. So closing, again, gaps, fair value, blah, 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 fancy terminology, right? They're just representations of auction theory. And as you've seen, you know, with IFVGs, they require a lot more steps. They require you to ask a lot more questions. They require a lot more confirmation. Yes, this means you're not going to get super sniper entries, but we don't need that. We don't need sniper entries. We just need confidence and consistency, right? The auction is what you're actually trading, not these magical names. Of course, we all call them FVGs, IFVGs, because that's what everyone knows them as. But hopefully that explains why we prefer IFVGs over FVGs. Again, trading regular fair value gaps is not inherently wrong. It just requires a lot less information. And so therefore, you will find that with trading IFVGs, you're often a lot more confident in your trades. And the trades you take will hold a lot more weight.